The Federal Reserve is in the room, and for the next 48 hours, nothing else matters more than what comes out of that building on Wednesday at 2 p.m. Eastern. Let me set the table for what is already baked in and what can still move the market. The Fed is not cutting rates this week. That is a zero probability event. The question is whether they signal a cut later this year, hold the line, or open the door to a hike. And based on the data since the last meeting in May, the risks are skewed to the hawkish side. Since the May FOMC meeting, we have gotten an April CPI print of 3.8%, followed by a May CPI print of 4.2%. We have gotten a PPI print with headline at 6.5% and core ex-trade services at 5.1%, the highest since October 2022. We have gotten a monthly energy inflation number that showed gasoline up 23% in a single month. And we have gotten an OPEC report that confirmed oil demand destruction is accelerating. But oil supply disruption from the Iran conflict is still the dominant price driver. The Fed has three primary tools in this meeting: the rate decision, unanimous hold at 5.5%, the statement language, every word of the first paragraph will be parsed for shifts on inflation risk, and the dot plot, the summary of economic projections that tells you where each member thinks rates are headed through 2027. The March dot plot showed 2 cuts priced in for 2026. That is gone. The consensus expectation is 0 cuts for 2026, with dots shifted higher across every projection year. Some hawkish members may even pencil in a cut for 2027 only. The median dot for 2026 is expected to move from 4.25% to 5.0% or higher, effectively removing the entire easing path that the market had been anticipating since January. Now here is the part that is not getting enough attention. The dot plot is not just about the rate path. It is also about the Fed's GDP and unemployment projections. In March, the Fed projected 2026 GDP growth at 1.8% and unemployment at 4.2%. Both of those numbers are now optimistic. Growth is slowing. The Atlanta Fed's GDPNow model is tracking at 1.3% for Q2. Unemployment ticked up to 4.1% in the May jobs report. If the Fed acknowledges slowing growth alongside sticky inflation, that is the stagflation acknowledgement the market has been dreading. The market is positioning for this outcome. The S&P 500 is essentially flat as I record this at 7,361. The Dow is up 30 points. The Nasdaq is down 0.2%. It is a waiting session. Volume is below the 20-day average. No one is making aggressive bets 24 hours before the Fed. The bond market, as I covered yesterday, has already done the repricing. The 10-year yield is at 4.15%, essentially unchanged from yesterday's close. The 2-year is at 4.50%. The inversion is still 35 basis points. The curve is telling you the bond market expects the Fed to hold this rate until inflation breaks, regardless of what happens to growth. Now let me check in on the 2 stories that were supposed to be resolved by now, but are not. Iran. No deal over the weekend, no deal Monday. The White House said overnight that talks are entering a technical phase, which is diplomatic code for we do not have a political agreement and we are punting to the working level. The Strait of Hormuz remains closed. Oil is at $83 flat. The market has stopped reacting to every Iran headline. It is waiting for a signature, not a statement. SpaceX is at $129.80 this morning. That is another 1% drop from yesterday's close and now 3.9% below the IPO price. The stock has not found a floor. The gray market premium of 28% that existed before the IPO has completely evaporated. SpaceX is now trading at a discount to its offer price, and until the strait reopens or the Fed signals accommodation, there is no catalyst to reverse it. Here is what I am watching for the rest of the day and into tomorrow. First, the Fed's statement language. If they add a line about elevated geopolitical risk to the inflation outlook, that is a hawkish nod to the Iran conflict. If they remove the word elevated from their description of inflation, that is a subtle dovish signal. Second, the dot plot. The median 2026 dot moving from 4.25% to anything above 4.75% will be read as a de facto hike signal. If the median goes to 5.0% or higher, that is 2 effective hikes priced into the dot path. Third, Powell's press conference. He will be asked about Iran, about the SpaceX IPO as a risk appetite signal, and about whether the Fed is considering a hike. His answer on Iraq in 2019 was, the Fed does not respond to headline risk. If he gives the same answer on Iran, that tells you they are looking through the conflict. If he acknowledges the risk, the door to a hike stays open. Let me give you the actionable framework. If the dot plot holds at 2 cuts or even 1 cut for 2026, that is a dovish surprise, and the market rallies 1 to 2%. If the dot plot goes to 0 cuts with a hawkish statement, expect a 1 to 2% sell-off. If the dot plot removes cuts and adds a hike probability, the market reprices sharply lower, 2 to 3% downside. Position for the range, not the direction. S&P 500 support at 7,200. Resistance at 7,400. A break of either level on Wednesday sets the tone for the next 2 weeks. Until then, the market is in a holding pattern, waiting for the most important Fed meeting since the pivot narrative began in January. I am Daniel Reed. Keep your data sharp and your logic sharper.